Benjamin, let's talk about where interest rates may be headed for the balance of the year. We saw the Bank of Canada increase its overnight lending rate by about 25 basis points midsummer. 3 more rate announcements left for 2023. What is your prediction?
The short answer is, quite frankly, and I will admit it, we don't know. It's really 50-50. The next meeting is September, it's coming, and the Bank of Canada is looking at the indicators that are telling you that the economy is slowing down, even inflation is slowing down, the unemployment rate is rising. At the same time, inflation is still too elevated because the target is 2%. So what to do? They also know that there is a risk of overshooting, and this is, at the end of the day, a biased bank. The Bank of Canada will take a recession over inflation any day, which means that if the decision is undershoot or overshoot, they will overshoot. And that's the only reason why we still apply about 50-60% probability of a move in September or October. There is no need to raise interest rates. The economy is slowing down. The housing market is slowing down rapidly. Even inflation is behaving if you measure it correctly. But the risk is that the Bank of Canada will move again. So quite frankly, at this point of the game, it's really 50-50. It's very possible that they will wait and skip September and see what happens. And if the unemployment rate does not continue to go up, if inflation is still sticky, they will move again in October. Regardless of the date, we are very, very close to the end of the hiking cycle at this point.
Let's talk about some of the data that came out over the course of the summer that could help the bank make that decision. You have mentioned, of course, that unemployment number, which was at about 5.5% in July. Core inflation, can you strip that apart? Is that where the bank wants to be? Are those numbers headed in that direction towards that 2% target?
Yeah, so let's start with the labor market. You're getting mixed signals. On the one hand, the unemployment is rising, and that's quite frankly what they would like to see. But at the same time, the labor market is still very strong because we got all those new immigrants adding to employment. So employment is rising, but unemployment is rising even faster. So what to do in this environment? Wages are starting to slow down. The labor market is normalizing. The number of vacancies are falling, but it's still higher than it used to be. What to do? Then you look at inflation. The headline inflation, definitely a disappointment. It was stronger than expected. But again, if you look at the inflation minus interest payments on mortgages, it's basically very close to the target. And I submit that this is the way to look at it, because nobody will be able to convince me that higher mortgage interest payments are inflationary. They are disinflationary, but they're rising by 30% on a year-over-year. If you remove them from the calculation, you have a situation in which the inflation rate is actually very close to target. So again, the Bank of Canada knows that, what to do. So again, it's very possible that they will wait a little bit more. Maybe they will skip September and then decide whether or not to go in October. But the economic numbers are very mixed. For every bullish number, I can give you a bearish number. And that's what the Bank of Canada is facing. And that's why, quite frankly, they're a bit confused at this point with the market. The market is also confused.
Let's talk about the language that's coming out of the Bank of Canada. Let's also bring in our neighbors to the south. What are you hearing from the Federal Reserve? We recently heard from Chairman Jerome Powell midsummer. Are they on the same path? What does the language look like from the two central banks?
Yes, they still have to keep a hawkish tone, both of them. Because remember, if you start relaxing about inflation, guess what will happen to the long end of the curve, to the 10-year rate? It will start going down. And they don't want to see that. They would like to see rates still elevated to keep the momentum going, slowing down the economy, raising the unemployment rate, and lowering inflation. So you cannot be perceived that you are relaxed on inflation. Therefore, they have to be relatively hawkish and continue to remind the market that they are data dependent. Basically, whatever happens, they can change their mind and continue to raise interest rates, keep the market guessing. And I think both of them are trying to do the same thing. Keep the market guessing. And by doing so, you provide some upward pressure on the long end of the curve and keep rates from going down, which is prematurely in their view.
For some time now, we have seen the two central banks on divergent paths. Do you see these paths coming together again?
Well, that's very interesting because the market is still expecting the Fed to move at least one more time. That's our expectations, and then call it a day. The Bank of Canada maybe will move one more time and then call it a day. Both of them are very, very close to the end. So I don't see much change now in this trajectory. I see a situation in which both central banks will end. The question is, when are they going to start cutting interest rates? And I don't think that it will happen anytime before the second quarter of 2024. So we have a lot of time with elevated interest rates before we start cutting. It's very crucial, especially in Canada, that we start cutting in 2024, because in 2025 and 2026, 55% of mortgage outstanding will be reset. You need to make sure that those rates are lower, otherwise the reset will be very painful.
Let's talk about that trajectory of rates over the next few years. Of course, you had mentioned that outlook 2024, 2025. What is your expectation, I guess the percentages that we might see that drop for next year and the following year?
Yes, so let's first of all talk about the Bank of Canada. We have a situation in which we started this madness, COVID, at about 175 overnight rate. We are at 5.25, and then we stayed there for a while until interest rates started going down in the second quarter of 2024. By how much? I suggest that it will go from 5.25, 5.5, whatever the number is, to about 3, 2.75. Much, much higher than it was before COVID, because we have all kinds of long-term inflationary forces like deglobalization, just-in-case inventories. The labor market is not as giving because of demographic reasons. All those forces are inflationary, which means that you will need higher interest rates, higher neutral rate of interest in order to maintain the target, which is 2% inflation. And that target is not going to change anytime soon. So my prediction is that interest rates in 2024 will start going down, will continue 2025, and will stop at around 2.75, 3.